Hello, my name is Gary Krebs. I'm a financial advisor with GSK Wealth Advisors. Today, I'd like to do a short video covering our investment outlook for the remainder of the year. The summer's often a good time to reconsider your assumptions and how you feel about the future. Let's go through it. My first point, and what we think is the most important factor determining how the market's going to move over the next 6 months, let's say, is the health of the economy. To us, the economy is in very stable, healthy condition. We've been growing 2 to 2.5% for this year and for 2, 3 years before. Today, it's half consumption, half investment, led by AI. We think this situation is most likely to continue, supportive for the market. Second issue is inflation. This is a little more shaky because of the Middle East conflict, which has driven oil prices way up and then down and up again. However, given that inflation overall, the last print was about 3.5%, which is not horrible at all, nothing compared to 2002 when we almost reached double digits. And underlying is closer to 2.5 to 3. Given the current situation, we think it's likely to continue. We're presented a graph which basically shows the short-term rate controlled by the Fed, the central bank. We don't think it's likely to change much up or down, maybe a quarter point up, a quarter point down, but won't have much impact on the market. So again, supportive of a continuing rally. Point three relates to something more gritty, which is earnings. And this has been a great surprise to the market, to investors. We went into the year expecting something like 12 to 13%. We're right now traveling at a level of 25%. So, companies across America across many sectors are basically ringing up their cash register and and generating tremendous revenue growth and tremendous profit growth. We don't think 25% growth will continue, but even half of that, something like 10 to 12%, we think will be supportive of the market going forward. Point four relates to longer term interest rates. And so far during the year, they've been very, as we would term it, boring. They've been either side of 4.5%, despite, oil prices almost doubling, then coming down and going up again recently. This is an important point because they are basically a benchmark for mortgage rates for individuals, for corporations, loan rates, etc. We think they remain boring. Market likes boring, supportive. Point five, market sentiment. Now, despite us having a good year so far, as of mid-year, we've been up almost 10%, which would be great if it was the whole year, higher than the history. But despite that, the market remains very cautious. Whenever we get some kind of event, whether it's the Middle East conflict boiling up again or some large company not quite meeting their earnings expectations, the overall mood turns quite cautious, negative, suspect. We call this the wall of worry. And, paradoxically, we need this wall of worry. We need sentiment to be careful and not too ambitious in order for the market to continue to go up. We call this climbing the wall of worry. We think it will continue. Finally, point six, the rally is, a lot of people were very critical that the rally was just being led by large cap technologies stocks as a function of the AI revolution. Certainly, this was true from mid or late 22 to mid 25, but over the last 9 months, the rally has broadened out. Much more sectors are participating, industrials, materials, small cap stocks, which doubled the performance of the S&P in the first half of the year. They're all starting to perform well. And so we see recently, despite the fact that these large cap technology stocks are probably down anywhere from 5 to 20% from their highs, the overall market was able to make a new high last month, which tells you there are many more companies generating strong earnings and participate and basically pushing the rally forward. So our overall summary is to us, the market looks like it's in a good place. The macro factors, GDP growth, economic growth, 2.5%, great. Inflation, more or less under control. Don't expect any big moves by the central bank. And at the more micro level, earnings have been doing great. They won't continue at this pace, but even as I said, half the pace is great. And we're getting a broadening of the rally. So more and more stocks, more and more sectors are participating. For us, this just adds more fuel, as we say, to the mix and to the rally. If you'd like to discuss our investment outlook in more detail, be happy to engage with you. You could contact us through our website, GSK Wealth Advisors, or you can click onto our QR code on the lower right-hand corner, and that'll take you directly to our website. So I have to present a few disclosures. Here they are. Again, hope this video was helpful and look forward to seeing you in the near future at our next video. Thank you.